All right, it's 6:01, so let's get started. So good evening, everyone, and thank you for joining us today for our professional education event titled Grow Your Net Worth, Starting Your Career on the Right Financial Foot. This 1-hour session is being hosted by CBM, and perhaps for those of you who are not familiar with me, my name is Alex Selesnov. I'm a partner at CBM. I'm the director of financial planning and wealth management. Reema and Abbie are my teammates. And for those of you who are, perhaps less familiar with CBM, we've been around for more than 100 years, and our services evolved over, a little more than a century. We focus on tax and different types of advisory work. But of course, in terms of our webinar today, on the financial planning side, what actually makes us unique, we're one of those few firms in the area that is able to provide all three services: tax, financial planning, and investment advisory work in-house. We do not outsource any of it. We do all of it in-house. We have access to more than 40 CPAs on staff. We have 6 certified financial planners. We have 4 certified divorce financial analysts, almost 3 chartered financial analysts. So one of the teammates will soon get this certification, and of course other people with other backgrounds. We always serve as a fiduciary when we work with our clients. So every type of advice that we provide has to be in our client's best interest. We're fully independent, so we're not part of any brokerage house, and we're a so-called fee-only firm, which eliminates many conflicts of interest when clients work with us. Of course, our presenters today are Reema Patel and Abbie Niehoff, and a little bit about them. Reema is a manager at CBM with nearly 10 years of experience in public accounting. Her experience includes tax and financial planning and research and preparation for individuals, businesses, and not-for-profit organizations. Reema is a co-director of DPath, the Diversity and Inclusion Group at CBM that provides leadership and business development and networking and empowerment opportunities for women and minority professionals throughout the firm. She was central to the firm's initiative to develop a business plan to deliver financial planning services to Generation X and Y professionals, and that was great, actually. Reema is a certified public accountant, certified financial planner, or CFP professional, and a financial associate with MBI Investments, CBM's wealth management subsidiary. Abbie is a financial specialist at CBM with more than 5 years of expertise helping individuals and young couples across broad areas of financial planning. Her most recent article, Creating Financial Harmony, Living Together, Engaged and Newlyweds, focuses on building understanding between couples in complex financial matters. Abbie also works closely with individuals, couples, and their attorneys to resolve the financial aspects of divorce. She is collaboratively trained and a trained mediator. She is also a certified financial planner professional and a certified divorce financial analyst, as well as a financial associate with MBI Investments, again, CBM's wealth management subsidiary. So a couple of administrative items, if you want to move to the next slide. We're offering CPE for this session. There will be four polls launched during the next hour. Please reply to at least 3 of them. They'll appear in the main meeting screen or in the chat box. The CPE certificates will be sent out within 2 weeks to the eligible attendees. Any questions you submitted during registration have been sent out to our presenters. They'll cover them throughout the presentation, but you're certainly encouraged to use the chat box if anything else comes up, or basically if you want to ask a question. This session is being recorded. But for privacy purposes, anytime you ask a question, when you type it in the chat box, the presenters will read it out loud, but they will not mention your name. And again, they'll either address it throughout the webinar or during the Q&A session at the end. Within the next day or 2, we'll send out an email with the presentation slides, a link to the recording, and the opportunity to send out any follow-up questions to the presenters. And with that, I'll turn it over to our presenters. Thank you.
Okay. Thank you, Alex. Reema, do you want to go to the next slide? Okay, so today Reema and I will be talking about the following topics that you see on your screen. And each of these personal finance topics are very important to be aware of and will help you start your financial future off on the right foot. We'll start with knowing your worth. We'll talk about a bit about net worth with that, understanding your goals, saving and investing, managing debt, protecting yourself and your family, taking advantage of tax planning, and taking control of your career.
Okay, so this might sound basic, but I think it's important that we step back a little bit and start from the beginning. You need to understand what net worth means. And the fact that you're all here today shows already a pretty good start that you are interested in securing your financial future. So kudos to everyone that joined today. I know it's evening time. Everyone is busy, but I think you'll take away a lot of important information out of this. Net worth means, it's your assets minus your liabilities. Your assets include your bank accounts and investments. These are your obvious ones. A lot of people forget retirement accounts because it's sort of, you're hiding money away for your future. You're not touching it for decades. It's not accessible to you right away. So you don't always think about it on the day to day. But this is an asset because it is accumulating wealth for you, and oftentimes it is being invested. So it's growing throughout your lifetime. So definitely give yourself credit for the work that you're doing there. A house. This can be an asset. Don't forget that a lot of times houses are financed via a mortgage, so that is a liability. So you need to look at the equity that you have in the house, which would be, the value of your house minus the outstanding mortgage on that. Cars sometimes can be considered assets. Also keep in mind that they depreciate in value pretty quickly. And a lot of times they'll also have a loan attached to that. The most important one I can think of is yourself. And as Abbie just mentioned, we will kind of cover a little bit of ways that you can protect yourself when it comes to thinking about your financial future. And then liabilities is, so, assets are everything you own. Liabilities are what you owe. Mortgage, car loans, as I mentioned, student debt, credit card balances. And the key thing to know about the net worth is that it is a snapshot of your financial situation at a specific point in time. So as you start thinking about how you're going to implement some of these strategies for yourself to grow your net worth, you want to be able to track that data and see how it's changing and what's impacting it. Because the way that you grow it is either you increase your assets or you decrease your liabilities. And so knowing what the things that you are doing currently, how it's impacting your net worth is extremely critical information that can help you adjust what you need to do so that you can keep meeting your goals. So a fun little exercise here. If you will please use the chat to type in two numbers, what you think is the average net worth and what you think is the median net worth for Americans under age 35. Go ahead, start typing. And then I'll reveal the answers. I always like this one because it's kind of shocking to me.
Me too. Interesting. It's interesting to see the spread between the two.
We need some engagement. So I'm not seeing any chats. Let's hear at least one.
40K and 60K.
Okay.
Is one.
I could say my thoughts were probably higher than that when I was first thinking about these. What were your thoughts, Abbie?
That's a good question. I feel like the average was low just because you have to consider people just out of school who actually have a negative net worth, and then people like Kylie Jenner who are billionaires. So skews it.
Yeah. All right, we got quite a
25K.
Yeah, 50K and 70K. A couple of those, 25K, 10K, 40K. All right, 50 and 45K. So I'll reveal a median. So this is the middle point of the data, right in the middle, 13,900. Average is 76,000. I thought that was pretty wild, to be honest. And this is based on, I think it was earlier 2022 or 2021 study. It's grown actually in the last couple of years. It used to be, the median used to be closer, the average I think used to be closer to like 5,000 or 6,000, which is wild. And then the average and median household net worth. If you want to, go ahead, answer, put in the chat what you think it is for ages 35 to 44. And while you're doing that, I just want, so Abbie was talking about how the averages get skewed. It is kind of hard to, I always like to look at both the average and the median, because the average is not still an accurate picture because you have the very few at the ends. And so when you're comparing yourself to the average, I always felt like it wasn't, I always felt like I was behind. But when you look at the median, if you're thinking about the time period from when you've graduated college to age 35, right, about 10 years, 13,900 is
attainable.
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 Yeah. Okay, we got 40 and 120, 40 and 100, 35 to 45, 60 to 20, 140. Okay, so a lot of similar ranges there. Let's reveal. Median 91,000, average 436,000. Wild. What I take away from this is, you see how exponentially that changes, right? In your first 10 years after college versus the following 10 years. There's a lot going on there. A lot of strategies of how you're using your money to grow, accumulate your asset. It is increasing exponentially because it is being either invested in the market, or you started paying off debt, or you're, making more money, things like that. So while it seems crazy, it is not that you're starting off early. It is not that, hard out of reach. One of the general rules of thumb that we get a lot of questions about how much you should be saving by what point. And there is a benchmark out there, half of your salary by the age of 30, 1 time your salary by 35, 2 times your salary by 40. This is a good, it's a good benchmark to use to kind of set your own goals. It's not a hard and fast rule. Everybody's situation is different. It's not going to work for everybody. I wish it were an exact science who could tell you exactly how it works, but as my boyfriend would say if he were talking to me right now, only the stiff deal in absolute. So there is no absolute rule here. It's just a good way to, it helps you frame how you're going to set your goals and how you can achieve them. I also like this graph. So we talked about the importance of tracking your net worth because you really need to understand your own financial health, right? There are apps out there like Mint, which I use and love. There's also Personal Capital. You need a budget. Some of them are paid, some of them are free. They will do sort of the hard work for you. You can always track them in Excel too, but who wants to? We're busy people. Who wants to spend the time doing
Too much
that?
work doing that.
Yeah, so automate it, make it simple. What this graph is showing you here, the orange line, that's the net worth over time. We're starting at like age 25. Actually, I can't even read the numbers to 10, 20 years. You see how you start off in the negative in the beginning? This is totally normal because you're right out of college. You have a lot of school loans and barely started working. So you don't really have a lot of asset accumulation going on here. You're earning income. You haven't had a chance to really save any of it away yet. You haven't really had a chance to invest a lot of it. So you're in the negative. But over time, it starts to quickly grow. And as you start investing it, and especially as you start investing it, properly, making sure you're balanced, reducing your exposure to risk, it grows exponentially because it is earning on itself. And so whatever you put away is earning money. Whatever money you just earned is also earning money. That's called compounding interest, and we'll cover that in a bit too. But you see how quickly those middle shaded green bars grow over time. And then as your debt starts to decrease, you start paying off your loans, that also spikes some of your net income. And then around the 10-year mark is where we really start to see it, peak because, presumably you're increasing your pay. Like I said, paying off your debt throughout time. It feels like it's taking forever at the time, but you look back 10 years later, it's actually taking quite a big dent. And then you might see it drop back down again. And that could be because you took out a loan to pay off, to pay a car, or you bought a house and now you have a mortgage. But you see how by that point, because you've been implementing some of these strategies, setting aside, investing, saving, growing your assets, it doesn't hit you as hard as it does in the beginning when you don't have as much to work with, right? So all the more importance, the benefit that we have now is time. It's on your side. It is your friend. It's going to help you grow all of your assets in this way.
So next we're going to talk about understanding your goals. If you want to go to the next slide. So, oops. Okay. There's a poll that just popped up. So growing your net worth. This is just the general plan of attack. And this is to keep in mind when you're looking at this, that these steps can and do overlap with one another, especially as you move down the line. And this is a really good guideline if you're not sure where to start. Step 0, which is first and foremost, you need to set a realistic goal for yourself. You need to reduce unnecessary expenses and just try your best to stick to a spending or plan or budget. Step 1, which is the most important place to start, is that you need to build an emergency fund. This should be built up to cover about 3 to 6 months of your expenses. And it's also important to note that you should keep your emergency fund in a liquid spot. Liquid meaning you keep it in a bank, a money market, or a bank account or a money market account, preferably a high yield checking or savings account, because your emergency fund, you need to be able to access that quickly. You shouldn't invest it or put it in some other source of non-liquid fund or place, just because if something were to happen, you lose your job, you need to get a new car, you need a down payment for your house. If it's in an investment account and it's invested in the stock that just tanked, when you need it, it might not be there. So it should always be kept in a very easy to access place. Step 2 is employer sponsored match funds. So if your employer offers matching contributions to a retirement account, make sure you're contributing at least the minimum to get that full employer match, because that is free money. And for steps 3 to 6, remember to grow your net worth. You want to increase your assets. And then steps 4 to 6, or these are just really decreasing your liabilities. For step 3 specifically. And these all, as you move down the line again, can be done simultaneously, and it really all depends on your personal plan, wants, and needs. So next slide. So budgeting and cash management. The key part of developing a budgeting and cash management plan is to do some self-evaluation and really understand what your habits are, what your relationship is with money, what incentivizes you, what motivates you, etc. People spend or save for a ton of different reasons, and self-awareness of your relationship with money can help your relationships. And financial issues often do play a major role in your personal relationship. So understanding your personal relationship with money and being able to communicate that with your partner is very important. Next, understanding what drives you to save. What do you want to save for? This is something you can have a lot of fun with too. So do you want to save for a house? Do you want to save for a car? Do you want to save for your wedding, kids, some luxury vacation, $300,000 car? You can have fun with this. So say you save X amount of dollars, you can go to Bermuda for a month. Could be fun.
Big
And
goals.
then, yes, big goals. You can do whatever you want with that, but just make sure to have fun with it and don't make all of it quite as tedious as sometimes it may seem. Yeah. And then when creating a budget, make sure to look at your paycheck and account for your tax withholdings, which is federal, state, Social Security, Medicare, and account for deductions like health insurance, and make sure you're factoring that into your budget. For example, a single earner in DC making $75,000 a year would net approximately $52,000 after taxes, and even less than that after you deduct for health insurance, retirement, and other miscellaneous deductions. So that would leave you with, I don't know, let's say $48,000 a year or $4,000 a month after you take all of that into consideration. And then this is just an interesting statistic that the average personal savings rate has past 20 years have averaged around 7 to 8%. But in April of 2020, mainly due to COVID, this actually spiked to 33%. But now, as of June 2022, it was back down to 5.1%. So that really paints a clear picture of how you can save more, or most people can save more if you really want to. I mean, April 2020 was a bit of an extreme because you literally couldn't do anything. You couldn't even really leave your house, and at that point you were Cloroxing your groceries. But there are different methods and different places to save if and when needed.
Yeah, and by no means do we want to encourage everyone to go back to that quarantine lifestyle where you're not spending on anything. But
yes,
drastic times call for drastic measures. You don't need to go up to 33%. If you are at 0% right now, let's work on getting you to 1%, 2%, and then keep that going until you're able to meet your goals, because it is doable. You just have to follow these strategies that Abbie's been talking about, especially with the budgeting and understanding yourself a lot more too.
Very true. So the cornerstone to success. This is really always just making sure you're living within your means and spending wisely. If you don't have the money, don't spend it. And if you have to spend money that you don't have, make sure you have a plan in place first. Consider adjusting your budget if your rent's more than, say, 30% of your take-home pay, if your car is more than 50%, or your groceries are more than $300 to $400 a month per person. That's actually, Reema and I were looking up the updated statistic for this the other day, and with inflation recently, this has gone up. So $300 to $400 a person now is a good kind of benchmark to look at for that. And just a general acronym to remember when it comes to budgeting is to be SMART. S is for specific on goals. M is measuring those goals. A is assignable and accountability on those goals. R is an important one. That's being realistic on your goals. And T is just really being aware of the time frame for those.
Oh, so maybe a month in Aruba is not as realistic.
Oh, that would be lovely, though. So saving and investing. So this is a fun slide. We're going to ask you to write in what you think this is too. So it's an interesting concept, just showing how little you have to invest and to save over time. This is not to say by any means to never go out and get coffee or go out to eat. It's just showing that if you alternatively put some of that money towards investing, you'd be able to save a lot over time. So let's see here. If you paid $4 a day for a cup of coffee, which was $120 a month, or $1,440 a year, if you were to invest that, and then say you invested it for 30 years and you had 6% annual return on that, what do you think the total after 30 years would be? 420,000 we have.
All right. Do
we have any other guesses?
All guesses are welcome.
Yes.
I'm going to say 300,000. I don't remember the answer.
I don't remember the answer either.
All right. 113.
Not bad. So $4 a day in 30 years, you could have over $100,000.
That's
attainable.
It's not good. 300 or 420 like we hoped, but
that'd be nice. I think the $20 a day would be closer to that. So what do you guys think if you were to save $20 a day that you would spend on going out to eat instead in 30 years, what that would be worth if you were to invest it for 6% annual return?
Oh, 400K for 50. Okay. All right. 400 to 500, 250, 600. Let's reveal it, shall we?
Mm-hmm. So almost $600,000. It's a lot.
Yeah.
And that's doable. $20. I mean, it doesn't have to be $20 a day. $600 a month, especially when you're first starting out, that's a lot. But as you can see, $120 a day, that's still a lot of money. And it's better to invest what you can, even if it's $10.
Yeah.
It's something and that will be working for you.
And if this is, your favorite hobby, that's fine too. What you want to do is figure out how you can set your goals, how you can adjust to other areas so that you still get to do the things you want to do without sacrificing your own security, right? That is the whole point of all of this.
Yep.
So if you remember the slide that Abbie just went through with the colored boxes, how do you start in attacking, your general plan of attack for growing your net worth? When it comes to saving, same question, right? Where do you start? Emergency funds. Absolutely 100% you started with emergency funds. Make sure you have enough coverage for yourself. We talked about 3 to 6 months of expenses. Make sure it's accessible and it's liquid. It retains its secure, low risk. And then after that, you have a lot of varieties of where you want to go next. And this is sort of, the boxes that Abbie was talking about. It's not necessarily in any order. You can kind of move them around depending on what works for you, and what your situation is. But you do want to, maybe put the free money concepts higher up on your list because you want to try to maximize the employer match or profit sharing that your company gives you, because they're basically giving you additional money that's going to then grow and grow and grow. If all you do is put aside, X dollars or X percent. Start there. Look into some, they used to have really great deals on high yield savings accounts. I don't know. I mean, that hasn't been around for a while, but it might come back, soon. So keep an eye out on those because a lot of times they would offer some great sign up bonuses. My mom was really great at hunting of all the best deals. And then she would just sign up for the ones that had, put in $500, you get $200 bonus. Easy way to make your money work for you. And again, it's basically free money, right? Just make sure you read the fine print that there's no additional fees or requirements that you have to do something with it in order to earn that without a penalty. And then, after that, you can go focus on maximizing your IRA accounts, your 401ks, putting any excess into your brokerage or investment accounts. The maximum contribution for a 401k is around 20,000. That is a lot. So don't feel bad if that's not something you can do right now. Most people cannot, but work towards it. Start somewhere and start increase it by a percentage or a dollar amount every year. That's what I did. I started off small, and then I set it so that it would increase annually by whatever percentage. Hopefully that means your raises are coming in every year. So while you're getting a raise, you're also increasing what you're putting aside for yourself. Pay yourself first, right? That's the whole point of this. But I just say that because it takes a lot of time. It'll take a while before most of us are able to ever get to that maximum of 20,000. So don't let that set you back. Use it as a way to incentivize you to reach that goal in the future.
So this is a good visual on compounding interest. Over time, even if you invest a little, you can just see how much that can grow over time. So you invest $1,000 a year, which is 83 a month, or say 40 or so dollars if you get paid biweekly. So $40 per paycheck. And assuming investment returns of 7% a year, you would have over $400,000 in 50 years. And I think that's a very attainable small amount that most people can contribute. So if it's just as little as $1,000 a year, you can see how much that would grow over time. And the more you invest, the more it works for you. So your gains will continue to be added onto that account, and those gains would also be growing and helping you grow your, as Reema had highlighted earlier, help you grow your net worth.
All right, some investment options that are available to you. So obviously individual stocks These are basically have a piece of ownership in a company. Keep in mind, if this is this is really your passion, this is what you want to do, it is risky. So make sure if this is how you want to invest, you are taking a careful look at how you're doing it, and that you are still diversifying and reducing exposure to risk. So you don't want to put all your eggs in one basket. And even though generally, right, like there's again, another general rule of thumb out there for people earlier in their careers, younger, when you have time on your horizon, they say you can invest more, you can increase your asset allocation so that a higher percentage is in equities and stocks. But that also does not mean you don't need to diversify. You always need to diversify, make sure that it's still a balanced portfolio. Exchange traded funds and mutual funds, these are great ways to help you kind of do, basically simple investing while achieving that diversification as well. They are easily accessible nowadays it basically made the average person able to invest in the market, which was not always the case for a long time. So that is a pretty big deal. And you don't have to start somewhere big. You can just take a small piece and start somewhere, play around with it a little bit, see till you get comfortable, figure out what you like. With mutual funds and ETFs, they track different indexes, or they're packaged in different areas. And so find, like ESG funds, find something that you like, do some research on it, and figure out how that works for you. And then as you get more and more advanced in your investing strategies, you can look at a little bit more sophisticated assets like private equities, real estate, physical assets like gold. These are a little bit, they require a little bit more upkeep and understanding. So it is important that you consider that if you're looking to include that in your portfolio. We do have a pretty good, if you want more information on investment performances, we do have a pretty good quarterly investment update that's held regularly throughout the year. I don't remember when it is next, but I think it might be on our slide. So keep an eye out for that, or reach out if you want to know more about that.
Okay, so some key ideas are really just having discipline and having time on your side, which as young professionals, we do have time on our side now. Setting up a simple and automatic investment plan, having automatically, say, set up your paycheck so it would direct deposit into an investment account, or have automatic transfers set up so you don't even have time to think about transferring that. It would just automatically transfer into some account, and then you wouldn't be tempted to spend that. 3 to 5 funds is generally enough to start out and be diversified. And just again, having that automatic transfer set up every paycheck is a good way to keep yourself accountable. A neat concept is the rule of 72. So 72 divided by the annual rate of return is the amount of time it would take to double any investment. If you want to go to the next slide for the myths, Reema.
We did get a question related to the index and target date funds, so I'll just jump in real quick since it's on this bullet. Target date funds do a pretty good job of rebalancing the portfolio as you get closer and closer to retirement, but with one caveat is that it doesn't consider your entire portfolio. So they'll only rebalance what's in that particular, right, what's there. So if you have assets elsewhere, if you have an IRA in a different account with a different balance and, investment brokerage account elsewhere, it's not considering all of that. And you really need to look at your whole portfolio, all of your accounts as a whole, in order to make sure that it's balanced appropriately for your risk tolerance and your needs.
Mm-hmm.
Common myths. Just wanted to point out a few things real quick, because I do hear a lot of these concepts, and I think that it's important that we clear up some of these myths or mistakes. But you don't really need that much to start investing. You can start off small. There are some funds out there that will require some minimums. You can look at that. You don't need to do those. There's usually also a more generally accessible one that may have a lower minimum, and some that don't have any minimums. So look for those. It's not that they're better or worse, right? So it is, like I said, you don't really need to have, thousands of dollars of assets available in order to start investing. You can do it now. Market is too risky is one that a lot of people are afraid of as well. There's several ways we can talk about this, but two main points is what is also risky is not investing appropriately for your risk tolerance, because if you cannot keep up with inflation, so if you don't invest in the market, that means you're basically not keeping up with inflation, more or less, right? And that is going to hurt you in the end because it'll cut into your net worth. Because it'll, you're spending more. Every dollar is costing you more and earning you less.
Mm-hmm.
The other way I think about this also is if you set up your automatic transfers, like Abbie was just talking about, that lets you capitalize on the ups and downs of the market, and that takes away some of that risk, right? Because now you get to buy in when the things are low, and you also get to see that grow up when things are high. So it's a good way to kind of balance some of that out. That's just one method. You don't have to do it that way, but it is a way that helps sort of dilute that risk a little bit. Investing is a lot simpler now than it used to be, especially if you look at some of the funds you were just talking about. I mean, not specific funds, but some of the vehicles that are available, because they are more accessible to a lot more people and on a lot more platforms,
Mm-hmm.
and at very low cost or zero cost. So just wanted to touch on those things. You don't have to be an expert or rich to do this or know that much. You just need just a little bit of knowledge to be able to do it, and I think you'll get some of that from this.
Mm-hmm. So a couple things to keep in mind is knowing your short-term, medium-term, and long-term needs and goals. With that, you should match the risk tolerance up accordingly and utilize those certain accounts and different type of investment vehicles as needed. Liquidity and risk is inverse. So the more liquid something is, the less risk it carries, and then the more risky something it is, the less liquid it is. So for instance, and we talked about, or I touched on this a little bit earlier too, but think about last year with that whole GameStop stock phenomenon that shot up and then tanked. And then you can look at cryptocurrency. So those things are risky, but you can, if you invest, I don't know. You can just see how risky that was. So if someone invested a lot of money in that, they could have didn't get out in time, they could have just lost it. So, but again, they could have made money. So who knows with that, but that's one thing to keep in mind. The more risk something is, the more you have the potential to make something, but you also have the potential to lose all of it or
Yeah.
most of it.
And if timing the market were easy, we would all be millionaires, right? There's no way, even the people who do this for a living, they cannot tell you how the market's going to go.
No.
So it's
Would be
difficult
nice
to
if you
do.
could.
Yeah, that's why it's important that you don't pull everything in one, concentrated area, and you try to kind of manage that risk.
Mhm.
An example of the risk versus liquidity conversation, right? This is a great illustration. So let's assume that, we list out a few different home prices on the left, on the first column. You want to buy a house. You're planning to save over the next 5 years for a 10% down payment. Now, if you were to put it in a cash or cash-like security, assume 1% return over 5 years versus in the equities or in investing in the market where you're assuming a 5% return over 5 years. Now, it seems the obvious thing in this scenario, right, is that, oh yes, put it in the market because you're earning 5%, you have to set aside less per month. So why are these numbers higher on the far right column? And that's because we're illustrating a 40% loss at closing. So in year 5, when you're about to take out the funds for your down payment, the market takes a dip, you're short, you've dropped 40%. And if you see the bar graph, that's basically a $20,000 shortfall in what you needed to make the down payment that you now have to come up with at the last second. That's a pretty tight financial constraint. And you can also see if you knew, right, it was going to drop 40%, this is how much you would have to put aside monthly. And you can see the two far right columns, you can see how it's much higher actually, by putting it in the market if you assumed a 40% loss at the end. So takeaway, don't risk your like high cash needs for something that you need in the short to midterm. You want that money available. You have a specific amount you need and you want that available at the end. So even though it seems very tempting to just put it in the market because it's going to earn so much more, and you might even be able to save some because you don't need to use all of it, don't take that risk. Don't fall into that trap.
And one thing I wanted to touch on before we move on to this section is to keep in mind that there are numerous fee structures for different advisors and planners out there. You should watch out for different kinds of fees. Fee only, for instance, is what you should, or not what you should, what you would like to look for in an advisor because they're paid by you to give them advice. They're not paid by the company selling the product like they are in commission-based fee structures. So fee only would be someone who's is just paid to give you advice that is to benefit you without getting really any external compensation or benefit by giving you specific advice for things. So just remember there's no free advice. So managing your debt. So if you want to go to the next slide. So paying down debt, and we'll go over each of these a bit over the next few slides. The key point to remember is that not all debt is bad debt. The strategy for reducing liabilities is not just to eliminate all debt, specifically debt, especially with those with low interest rates that help you finance an asset and thus grow your net worth can be very good and very useful, such as purchasing a house. And other debt, they don't really lead to an investment in your financial future and really only increase your liabilities with no corresponding increase in your assets, resulting in that's high interest rates, high fees, which all do cut into your net worth. You want to go to the next slide?
That's basically like consumer debt, right?
Mm-hmm.
You're talking about
Credit card debt, XYZ. And so student loan relief, I'm sure most of you have probably already seen this image. I just wanted to touch base on this briefly. So for those of you making under $125,000 a year or $250,000 for married couples, $10,000 of your federal student loans, hopefully, fingers crossed if everything goes smoothly, assuming it will be forgiven, and then $20,000 would be forgiven if you had a Pell Grant when you went to school. So the pause on student loan payments was extended to the end of this year, and you can cap your undergraduate federal student loan payments or repayments at 5% of your monthly income. So if you have private student loans, this does not apply to that, but it does apply to your federal student loans. So it's let's see. So it's also very important to fully understand the terms of student loans. You should always be aware of your interest rates, the monthly payments, and then the repayment term on those loans. The current interest rates are shared up in the screen, and you can see how widely those actually vary depending on federal, private loans, and whatnot. Forbearance, just to define that real quick, is the suspension of student loan payments. And a very frequent question that we get is, should you be paying more than the minimum on your student loans? The answer to this is it really depends. If you have a low interest rate loan, then no. You could invest that extra money and actually make more on that money invested than you would make by making those early student loan payments. But if it is a high interest rate loan, then it is worth paying down those sooner rather than later. So you're not accruing very high interest amounts on your debt. Do you want to go to the next slide? So consumer debt and credit cards. So one big thing that you should take away from this is to always pay the minimum. If you can't pay your debt in full, you should make a plan. On the graphic over here, you can see there's a snowball effect and an avalanche. So the snowball effect is you pay the minimums on all of your credit card debt, but you pay the most you can on that smallest balance. You pay that off, then you move to the next one with the next smallest balance. So just over time, that's one way to approach your debt, and over time it will snowball and you'll get it paid off. The avalanche way is the highest you pay off you put more towards the highest interest rate loan, first while still paying the minimums on the rest of your cards, so that you'll get paid off faster and with less interest. But that could also take you longer to pay off the larger balances, and then you might lose motivation over time by doing this. So this also, paying down your credit cards and whatnot, it impacts your credit scores. So making sure that you always pay the minimum payment on any debt you have is very important. And then over time, it helps you build your credit. You can check your, it's very important to get your credit reports annually. We have a link on one of the last slides. I think it's freecreditreport.com or annualcreditreport.com, where you can get 3 very full reports showing all of your different open accounts. And then you should check that annually just to make sure no one has fraudulently opened an account in your name. And this is also different than your credit score. The credit score, separate from that, that's also important to check because that will help you get better interest rates, help you qualify for instance, for a mortgage, for credit cards, whatnot. And it is, just to note, it is very helpful to have a credit card. It helps you, those help you increase your credit score, which helps you lower your rates for future debts, but you have to use it wisely. Again, make sure, don't make a big purchase on your card without a plan in place for how you're going to have to pay it off. Again, just rule of thumb, if you don't have it, don't spend it. And then using a credit card like a debit card is actually very smart because you can accrue rewards, points, whatnot, and then just use those alternatively for travel, for cash back, XYZ. So do you want to go to the next slide? So renting versus buying. This was a pretty common topic we get asked about.
Everyone's favorite topic.
Yeah, everyone's favorite topic. And it depends on everyone's personal situation. With the recent interest rate increases, people now can afford less house for what that dollar amount would have bought you previously. But then again, rent has also increased a lot over the past year. So renting. So if you're not planning on staying somewhere long term, renting may be a better option for you. You have the ability to easily move around. But then you also do have to deal with annual rent increases. But alternatively, you have very limited maintenance expenses. Whereas owning, if you're planning on staying long term, so say more than 5 to 7 years, owning may be a better option for you. And owning or buying a house is a form of investing. And as long as you, depending on the different mortgage types, which could be a whole different presentation all on its own, it's more of a fixed rent payment. So your principal and interest for a conventional loan stay the same. You're not going to have to worry about increases. If you tie in your taxes and insurance into your escrow account for your monthly payment, that could fluctuate slightly a year, but it's typically not huge. One thing to consider about owning is there are significant maintenance expenses. I personally had not a good nightmare, well, a nightmare when I bought my house with this. And I was very happy that I had my emergency fund and didn't put all of my money towards the down payment on my house. Because about 6 days after we moved in, our mainline sewer apparently had been full of tree roots and backed up into our basement. So we had to get our whole front yard dug up, get that replaced. And that was a bit pricey to get the whole sewer main line replaced. So,
and that
not
doesn't
fun.
come up on inspection or anything. Like there's no way you
Nope.
could have prevented that. There's no way you could have known that.
It might have, should have come up on inspection, but it didn't. People miss things. It happens.
Yeah.
But always just make sure, if you do go to buy a house, make sure you still have your emergency fund on top of that in case something happens, because things happen. The rule of thumb for owning is save about, was it 1% of what you bought your house for? Assume you'll have that and fix up maintenance costs every year. So if you buy a house for $400,000, assume you're going to be at least spending $4,000 a year on maintenance expenses. And another thing with owning is you lock in today's pricing. As you can see, even over COVID, if you look at housing prices pre-COVID and then whatever they decided to do last year, skyrocketing. They're historically, they just continue to increase. We don't know what the future is going to look like, but buying a house today will probably be cheaper than buying a house in 10 years if you look at historical trends in the housing market. Another thing is make sure you fully understand your cash flow. What about and when to buy? So every $10,000 financed is approximately $475 a month if you're looking at a 4% interest rate, and $535 a month at a 5% interest rate. Rates are important, but affordability is more so. So don't wait for the perfect deal to come up. You don't need to have a 20% down payment. There are many different ways to structure a down payment, and that would be something you could talk with your lender about, just different ways to structure that. You don't want to get stuck in the house poor situation where you just drop all of your money into a house and then you don't have money to furnish it, you don't have money to move, and not. So just keep in mind, it's not buying a house. You have the furnishing expenses, the moving expenses, the repair, the upkeep expenses, and that does add up.
Yeah, I think a lot of people underestimate how costly it is unless you really actually want this. And if you end up changing your mind later, it's even more costly because you've barely made any headway into equity ownership in that before, you're getting closing costs on both ends, which are several $1,000s. So if sometimes renting is a better deal if you can find, a really good deal that doesn't raise rent as frequently as other places.
Yep.
All about what's available at the time and what your purpose is.
A few tips before we move on is be careful of loan forgiveness. It is taxable. However, you should note that this new Biden student loan forgiveness, it's not federally taxable, but it may be taxable on the state level, and not all states have decided, or most states probably haven't decided on how they're going to treat that. So that forgiveness may end up being at least partially taxable.
Yeah.
Okay.
Sorry, were you done?
I'm not.
Okay. So an area I want to talk about next is very underrated, especially, starting out early. The most important assets I said, right, is you, also your family. So what are the things you should be thinking about to make sure that that is protected? And one area is insurance. You already are probably familiar with medical insurance. Make sure there's all different types of plans out there. You're somewhat limited to what your employer provides. Make sure you're comparing them both from coverage, deductibility perspectives, as well as premiums, cash flow purposes. Insurance is a needs-based approach, essentially. So not everyone needs the same type of insurance. And this is where it gets really tricky. And we could really talk about this for a long time as well, because things like, for example, life insurance, right? If you have dependents, if you have kids, if you have the income gap between two married partners, someone that depends on you or someone that you depend on, you want to think about life insurance, because what happens is that if that income is lost and you've got these expenses, are you covered? Is the family covered? And there are several different ways. There's so many different types of life insurance. There's some that are just pure protection that provides you just the income stream. There's some that let you invest as well. There's a lot to think about there. And it doesn't mean that, and also life insurance is cheaper when you're younger and healthier, and it increases, cost increases as you get older. That doesn't mean you should go out and get it now, because it may not be necessary for you. Be wary of the people that do try to convince you it is. There are people that get paid commission to offer to sell you life insurance. It's not always the right call for you. So make sure you're talking to somebody that is, as we talked about earlier, a fee-only advisor, someone who's acting in your best interest and recommending the right product for you. I would also say that short-term and long-term disability is very highly overlooked. Accidents happen all the time, and what will happen if you are no longer able to do your work, right? You could have reduced income, you could lose that income, and that could go on for an unknown period of time, extended period of time. And a lot of times emergency reserves are not going to cover that. So you do need to think about disability. With short-term disability, they usually don't start on day one. There is a 30 to 60-day waiting period before the first payout kicks in. So make sure you factor that into your emergency savings. Do you have enough to cover those first couple of months or whatever the period might be?
Mm-hmm. That can
Um,
also,
yeah, go ahead.
oh, that can also short-term disability. So for instance, if you're planning on having kids, that's an important thing to have if you're a lot of employers offer that. So for instance, if you have a complication with your pregnancy and you're not able to work and you use all your vacation and sick time, and then depending on what the maternity leave policy is, you could use that short-term disability, even though it is a percentage of your pay, to cover that period of time where you're not able to work. So that could also be used to extend maternity leave, kind of just with a decreased pay.
Yeah. The one thing I want to talk about medical insurance. If you have a high deductible plan, this allows you to also get a health savings account, which is a pretty great vehicle for both qualified medical expenses, and also you can kind of see it as a retirement vehicle too. So contributions into the HSA go in tax-free, pre-tax. A lot of employers may also subsidize some of that annual limit. So you might, again, free money we talked about, make sure you look at that. And then they grow tax-free, and then they come out tax-free if you are using them for qualified medical expenses.
Mm-hmm.
Keep in mind, if you use it for anything besides that, it is both taxable and there's a penalty. But once you hit retirement age, you can basically treat it like an IRA account. So it'll be taxable once you take a distribution, but you won't get a penalty if you use it for something other than qualified medical expenses. It is a pretty sweet deal, but you do have to make sure that you look at the high deductible plan that makes sense for you. We are getting close to the end of the hour. I will keep going. So if you're still interested and you're able to stay on for our last couple of slides, feel free to do so. If you have to drop off, no worries. This presentation will be available on YouTube, and the link will be sent out a couple of days later or tomorrow or something like that. So you can finish the rest of it at that point. Estate planning, this is another area that we don't really tend to think about as important until you're well into your retirement ages, but it is for everybody. And I just want the 4 things that I think you should take away from this, that you should be thinking about no matter what age you are, is make sure that you have designated beneficiaries updated on all of your accounts, and make sure you check them regularly to make sure that they're accurate. 2, I would suggest getting a simple will together, because what happens if in the event of a situation you don't really want to think about, or I know nobody wants to think about what happens in the situation, but your family is then left with having to deal with what's going to happen to your assets, and somebody else is going to make those decisions. And so it may not go to where you wanted it to go. Also, things that are in there may take a long time to get through court. So this is also kind of why the designated beneficiaries is helpful to have. 3, advanced healthcare directive. This is a medical form that lets you designate somebody to make decisions for you in the situation that you're not able to do so. Very important. And then 4, I would consider looking into a financial power of attorney that lets someone make financial decisions for you in the event that you are not able to do so. Very, very critical. These are some of the ways that you can protect yourself and your family, your biggest assets. I don't want you to take it for granted and brush it off as not having to think about it until later. Okay, last section, second to last section. We'll just run through some key takeaways when it comes to tax planning. Nobody likes to talk about taxes, I know, because this is what I do for a living. So I do hear this a lot. Make sure that you file your taxes on time. This means April 15th, give or take. If there's a holiday, you can extend it 6 months to file, but you cannot extend the date to pay. So pay your taxes by April 15th if there is a balance due. Take a look. I would suggest you go and take a look at your last return that you filed. If you had a significant refund or a large balance due, go back and adjust your withholdings. I do this every year. You can change your withholdings at any time. It is a really underutilized tool in helping you manage both cash flow and your tax liability. I know that the marketing agencies like to tell you that you want your biggest refund. That is simply not true, because that means the government has been holding on to your money for over a year, paying you measly little pennies of interest. So you could have had that money with you for a whole year, right? You could be using it to pay for your vacation. You could be using it to invest in the market. You could be using it to help you in any number of ways in the goals that you have just set, like we just talked about, right? So I do encourage you to take a look at that. What I do is when I review it, I just look at to see if it's significant balance due or a refund, I will go and look at that differential and allocate it out over the rest of the year and adjust my withholdings that way.
And you could use that money to go buy a puppy too if you want.
What about adopting? Isn't that free if you
Yeah, well,
adopt
not quite
one?
free. It's like I don't know, $60, whatever adoption fee.
Yeah.
Use your refunds for puppies. Moral of the story.
Yeah, there you go. And then if you have gross income less than $72,000, you have free filing tools available on irs.gov. This is really great. Make sure you take a look at that. A lot of states will also have something similar on their websites. And the other thing to think about is think of ways to maximize your deductions. It's hard to sort of get into the details right now here, but there are a lot of credits and deductions available. And also there's a lot of, if you're within a certain income level, most of these things start to phase out. So earlier in your careers, when you're likely to be in the lower income brackets, you could probably be able to take advantage of a lot of these credits and deductions. And
we had a quick question for estate planning in the chat boxes. What is your opinion on free online will making platforms versus paid ones? Meeting with an estate planning attorney for that one is usually your most comprehensive bet on getting all of those documents worked up. So if you have kids, if you have more assets, XYZ, the free online ones are good to have just to start out with, but eventually you probably, or we would encourage you to meet with an estate planning attorney to really just make sure everything is set up.
If it's pretty basic and you don't really have a lot, right, you could probably get away with the free online ones. But as you start accumulating your assets, as you start, if you have kids or, sibling, parent, whatever, someone that is dependent on you for something and you've got different things going on, I think it's probably worthwhile, one of the, money well spent, I would say. Savers credit is a tool, it's a credit that's available that most people probably don't know of. You get paid a credit. You get a credit for a percentage of your contributions that you put to retirement. This is available if your income levels are below $34,000 if you're single, or $68,000 if you're married filing joint. But pretty cool, little tool that's available out there. We talked about HSA contributions already. You could always also, there's different strategy techniques with Roth versus traditional contributions for IRAs. You do start to phase out of both deduction of the traditional contributions as well as ability to contribute to a Roth. And so how you can achieve that, there's different methods you can always talk about. Reach out to somebody, because that could also get very complex. Rules are always changing. There's different kinds of student loan related deductions and credits that are available if you're within certain income limits. And then I also suggest you look into some of these mortgage certificate programs. They are state-based. They're often available. There's different programs available for first-time home buyers. And again, it's a different program depending on the state. So you got to really look at the state that you are in.
So taking
last
control.
section.
Yes, last section. We're almost done. This is just a funny little intro for that. So the next slide we have is a really neat, just kind of form to look at when you are comparing different job offers, if you're analyzing how your current job meets with what your needs are, and then maybe looking and comparing what different jobs would meet towards what you want. So in this first column, you see you would just make note of how each of those different line items match with what your needs are. And then you would compare and say you have 3 job offers from employer A, B, and C. You would then rate those based on what their offers and different benefits and different perks that those companies have. Do that. And then you could total the scores at the bottom and see which one meets what your needs are. And then you could assess using that what job most closely meets your needs, when what job really you should be accepting.
Yeah.
And it's neat. Oh, go ahead.
The most important thing I think when I look at this and what I think about is that we're very fixated on just looking at compensation and salary. And so we always want to go for like, that job is paying a lot more, but at what cost? A lot of times it'll mean that you're working a lot more hours, or maybe you take a pay cut, but you have more balanced work life and the employer is matching a higher amount to your retirement plan, right? There's a lot of things that is not just salary related that you have to consider. Commuting is one. You could have a shorter commute. That takes away so much of your time if you have a long ways to go and you're required to be in and you don't really want to be in or something like that, right? Where you work also, geographic location makes a big difference. And then, yes, go ahead. Did you have anything to add?
Oh, no, that was it for that.
Okay.
It's just to look at different things that you sure should be considered when looking for a job.
Yeah, and then basically we have our great list of resources. We actually curate this ourselves. We put things that we either use or we have heard of as being pretty good resources, but some of my favorites are on here too. So I do recommend taking a look at these. And upcoming seminars, this will also be included in the slide. Take a look at that. If you have any questions, feel free. We'll stay on for a couple of minutes, so if you want to add anything you want us to talk about, we can just stay for another minute. I will point you to our email addresses and phone numbers on here, so you can always reach out. I believe the slides will be going out
Day or two,
sometime
I
soon.
believe.
Yeah, a day or two, and so you'll get this information there as well. We just want to thank you all for being here during this evening time. I know it's either preventing you from dinner or it's preventing you from something fun. So it means a lot to us that you were here, and I hope that I think it's a great step that you were showing that you're interested in securing your financial future. So really thank you for that.
Yes. Then if anyone has any just last questions, feel free to type it in. If not, we can end shortly.
Okay.
I don't see any questions coming in, so thank you guys all so much for coming in. And okay, can you repeat the pay yourself first idea? So that one really was setting up an automatic transfer or direct deposit from your paycheck plan. So you're automatically either transferring money into a savings account, into an investment account, into a retirement account. So you're not tempted to spend that. And so you can have that money then working for you in the future.
Instead of, putting everything into your checking and then transferring manually out of there to your different individual goals, you're less likely to do it. You're setting yourself up for failure. The more automated you can make it, the better success you'll have. And the first persons you should think about are yourself, your savings account, your 401k, your IRA, investment accounts, and then whatever is left over. I hope that answers your question, but feel free to follow up if not.
Yes. So there's any more, looks like that was the last one. So thank you guys all for your time, and I hope you all have a good night.